Look at the US housing bubble. From 2007, it fell over the next 5 years from 29 trillion, this is not billion, 29 trillion to about 22 trillion. That's almost a $7 trillion fall. Now that is big, and it hit the middle class of US, right? So that is a big hit. So does it happen in India? Yes, it happens regularly in India in real estate. Only thing is it's not measured well enough. Because you'll have friends coming from US and saying, you know, there is this office next to ours which was listed at $300,000 is now going for $60,000. That's the kind of fall that has happened. In India, real estate prices don't fall that badly, but yes, you may not be able to sell it. I know people struggling in Chennai, in Bangalore and some parts of Bombay, they're just unable to sell. You can always say that they are stuck on high prices because of some kind of fixture in their head that, oh no, I have heard this price, so they are anchoring around a price, maybe. But yeah, inability to sell, that is a bigger hit than many other small bubbles. So this, yes, the housing bubble is a big one, and that has been a big fall. The quicker recovery bubbles, the 1929 fall in the US market is definitely a big fall, because I think the market fell by something like 90%, but did it recover? Well, the great crash had both scale. First of all, it had scale because more and more people were then by that time started investing in equities, right? And the extreme run up in the 20s, right, the roaring 20s, books have been written about the roaring 20s, led to the 1929 crash. For whatever, I'm not getting into the reasons, that's not the purpose of this video. The 1929, there were 846 listed companies and the market cap was 90 billion US dollars. Now that can't be very small. Adjusted for inflation, this would represent less than 1.5 trillion, but 1.5 trillion is not very small, but it's not too big either, right? But it's much smaller than the housing scam or the housing bubble that we saw. The thing is, the speed at which the recovery happened in case of the great crash of 1929, given the dividends and all that added back, was only about 7 years. So the recovery time was not too long. So unlike, say, the Japanese bubble, where the recovery just didn't happen since 1989 when the market crashed, so that's a pretty long period of time. You watch these things. The dot-com bubble of 2000 took about 18 years to recover the 5 trillion loss that it made. Now that is a big one, right? If it takes 18 years for you to come back, that has been a big bubble. So that can be very hurtful. The Nasdaq loss, it really took 18 years for them to come back. The biggest bubble, I mean 1989 Japan, that was a big bubble. Are we into any of those kind of bubbles? I don't think so, right? We are now nowhere near those kind of falls which are possible, because some recovery will happen internationally, money will move, the RBI will come in and buy some or start giving loans against shares. So some of those things will happen and the market will recover. So those are not the things which bother me. What bothers me is, are we in a bubble, is a question which we will never be able to answer unless we stand outside our portfolios and say, what will be the impact on my life if the market falls 30% at a time when my income goes down and my house, which is my biggest asset, is illiquid? Then what happens to me? If I can answer that question and say, look, I'm adequately provided for the next 10 years, I've got adequate income from absolutely assured kind of guilt or things like that, then you can say you're prepared for the next bubble which hits you. And I don't know from where it is going to hit, right? So being prepared for such things by having a very well diversified portfolio, by living on much less, by creating streams of cash flow from different businesses or some real estate rent, some dividends, some interest and all that, by creating a diversified portfolio and all that, you can reduce risk. You will never be able to eliminate risk. Thank you. Welcome to Subramani. Please subscribe to the channel. Please hit the bell icon. I need to keep saying that once in a while because people seem to be forgetting that they need to do that also. Wealth creation, risk reduction, insurance, how to improve as an investor, and the mistakes which investors make. These are topics on which I have spoken very many times. So if you find some of this repetitive, I can assure you that this video is being made today, and I'm not mentioning the date because you might find this coming back after 6 months. No, that's not the thing. The question is, how do you create wealth? The fastest way to create wealth, or the only way to really create big intergenerational wealth, is by starting your own business and taking it public. Because for every rupee that you earn, you will get a PE of say 20 or 30 or whatever, and therefore your wealth gets magnified. That is the way how big wealth has been created, whether it is Sam Walton, or whether it is Azim Premji, or whether it is Narayan Murthy, Tatas, Birlas, Deepak Parekh, whoever. They have created wealth for the shareholder by just doing this, of creating companies, nurturing them during the difficult times, and then to unleash the market capitalization. So HDFC Limited had a fantastic market capitalization because it unleashed the power of the market on HDFC Bank, HDFC Mutual Fund, HDFC Life Insurance, maybe forthcoming could be HDFC, some other companies that they have, right? All those companies would be contributing to the market cap of HDFC Limited, and now of course it's HDFC Bank. So that is the best way of creating wealth, but that is not open to more than say 99.9% of us, because many of these companies fail also. The only big success stories are spoken about, like they say success has a bigger megaphone. So you hear more about that, and the millions of companies which have fallen by the wayside we don't even know. So if that is not the way for most of us, what is the way? So obviously first is for most people it would be shares, right? Stocks, equity, shares, whatever you want to call them. That is what most of us consider our way to creating wealth for ourselves, because we did not have the capacity or ability or whatever to create our own company and take it public. So obviously shares, equity shares is good way to create wealth, and that is the foremost for 99% of the middle class who has created wealth. So buying equity stocks, equity shares is the way to create wealth. If that is the way to create wealth, how do you go about doing it? Today you have a choice of opening a brokerage account anywhere, right from Zerodha to HDFC or ICICI or Kotak, India Infoline, many brokerage houses where you can go and open a brokerage account, bank account, demat account, 3-in-1 account as they call it, and start buying shares and creating your own portfolio. If you are not capable of doing that, for some reason you don't want to do that, right, or you're not capable of doing that, then the second option available to us is something called a mutual fund, which invests in a bunch of stocks rather than in one stock. Like you put all your money into one share and that does really well, right? So your 100 rupees that you put has now become say 5,000, right? So 50 times it has become. Is that good? Yes, it is good. But what is your overall portfolio return? That is going to be important, because you bought various shares, many shares. The total portfolio return is what you're looking for. So that when you see your equity portfolio return, let's say you have invested in 10-15 companies versus how a fund manager is performing, that is going to decide how much wealth you create. That for most people who are not well informed and who do not want to take the trouble to learn, you will be much better off in a mutual fund. And for mutual fund also, seeking the help of an advisor. Let me just give you an example. The multi-asset funds, right? Multi-asset fund of Franklin Templeton is treated as current income. Multi-asset fund of ICICI is treated as debt income, which is 20% plus inflation indexing for tax calculation. And HDFC, it will be treated as equity, because they've got a element of arbitrage into it, so that is treated as equity, and therefore it gets treated as an equity fund. So knowing which fund to invest, why to invest, how to invest, and through in which folio to invest. Should you invest in your father's name? Should you invest in your mother's name? Should you invest in your children's name? How to invest, the taxation, all that put together, if you don't have the knowledge, then you're better off going through an advisor to pick up funds for you, and when in this context I mean equity funds for you. That is step one of creating wealth, is buying equities. Similarly, you can be buying bonds, you can be buying bond funds. These are all ways of creating some more wealth, but equities takes the cake in most cases.